Hello everybody, welcome to another one of my investing videos. My name is Mark, and in this video I am going to talk a little bit about how risky are stock options, particularly when you buy them on earnings. And so I did something today. This morning I bought to open 2 call options, and they expire this Friday. That's tomorrow. And here they are right there, $15 strike price. And I spent $36 total in premium, so I'm risking about $80, and that's because earnings is tomorrow, and actually the earnings have already come out on steel. They came out after hours, and the earnings were good. It beat, and so steel closed at $14.40, and actually if we look at steel now, ticker symbol X, then you're going to see that the price is up, that it went up after hours. So see if it comes up here. Okay, here's the closing price right there. Okay, but if we go to my positions, and okay, here's the closing price right there, but if you look over there, the bid 1508, the ask 1516, steel is going to go back up because it had a good earnings. And so I bought to open 2 $15 call options. Now, even though I got it right, I'm still in danger of losing money, okay? And I'll show you why, because if we go, actually it hasn't even gone into my transactions yet, but if you look here, I spent $36 for $15 call options that expire on Friday. That's tomorrow, okay? That means that if steel doesn't go to $15.36, it can't go to just above $15. If it goes to $15.10, I lose money. If it goes to $15.25, I'll lose a little bit of money. It has to go to $15.36, and the reason is because I spent $36 per contract. I bought 2 of them, so that's $72 plus a commission, so I spent $80. So because I bought 2 of them, really steel, for me to make money and also pay my commission, steel actually has to go to $15.40, and it has to do that sometime between now and before the market closes tomorrow. Tomorrow's Friday, and that's when these call options expire. This was an earnings play by me, and the reason why I bought these calls is because if we look at my positions here, these are my 200 shares of steel. And these right here are my puts. Now these put options, I spent $285 a contract, and they're up to $360, and I bought 3 of them. Okay, and so I decided to take a little bit of risk out of this profit, and even though it's just paper, I haven't sold to close it yet, it's still profit. Okay, and so I made $75, right? 285 plus 75 equals 360, so 75 times 3 is 225. So I decided to take $80 out of that $225 and put it into the weekly calls. Now the danger with buying those weekly calls, and it really depends on your risk tolerance. Now I could have bought the $14 call, and the $14 premium was going for $90. And so I thought, well, I'd rather get 2 $15 calls instead of 1 $14 call. And if we look at the option chain here, these are the calls right now. And notice that it even says 0 days expiration. That's the calls that I decided to play around with, okay? And so now those calls have even dropped a little bit. And the reason is implied volatility, okay? So right now, these are my calls right there. Those are the $15 calls. And they're down a little tiny bit. So I'm going to need some help tomorrow, hopefully pre-market hours, and hopefully I'll get a little push. Like maybe it'll go up to, maybe steel will go up to 1550, and it would be great if it went all the way up to 16. You know, stocks tend to go crazy during the earnings, and because it still had a good earnings report, and we can even look at the report on this stock chart here, this trading view, which is one of my favorite things here. So put in ticker symbol X, and then we look at the news. And here it is right there. United States Steel revenues surpass estimates. So we could click on this little article here. And there's a whole article that explains that it surprised by 176%. So I'm really hoping for a nice surge tomorrow. And I would love to see the price of steel go up to $15.50 or even $16. If steel goes up to $16, then my two $15 call options that I spent $35 for will be worth $100 a piece, and I'll make about $150. But steel absolutely has to go up tomorrow, because if it doesn't, the options are going to expire. And if we look at my positions here, and these are my two calls right there. The $15 call May 3rd, 2019. That's tomorrow. They're going to expire. So if they expire, I have a choice. If steel doesn't go up that high, but it stays over $15, then I could just let the calls get exercised. And because I'm the buyer, because I'm long the calls, I end up buying 200 shares of steel, which I am seriously considering doing. Since steel had a good earnings, and it seems to be beating estimates, and people can't seem to make up their mind, should I buy steel or not, and now it wants to go up again, I'm seriously considering buying another 200 shares of steel and letting these calls do the job for me, because stock options are automatically exercised on expiration day if they expire in the money. And it looks like that's what's going to happen. Now, what I don't know is if steel will go up over the $15.36. If it does, then I make some money. If not, then I lose. Now, trading the options in this kind of a way is risky, especially when you're buying out of the money calls. And there's the price right there, $15.12 updated. So I'm really hoping for that push. But when you buy call options that expire like tomorrow, or in a few days, it's Monday or Tuesday, and the options expire on a Friday, now we're talking about risk here. Because when you do that, the option absolutely must go higher than the break-even price. The break-even price of a call option is the strike is the premium that you pay plus the strike price. So like in my case, I paid $36 for this $15 call, and then I add $36, and that means that this stock has to go up to $15.36. Well, it did go up a lot. It's up 5%, but it needs to go up more. If it doesn't, I lose money. So you got to be very careful, and you don't want to go buying hundreds of weekly calls out of the money, because the risk and the volatility is very high. And delta is another good way of explaining the risk. Okay, so if we go to the Greeks and we look at the deltas, this delta shows a 1, but look at the $15 call. This delta shows a 56. That means that there's a 56% chance that this call option is going to expire in the money. And if we go up to the 1550, then the delta goes down to a 33. That means there is only a 33% chance that you're going to make money on this call. So that means that if you were to buy this weekly call, which is now down to 0 days, and you were to wake up tomorrow morning when the market opens, then 2 out of 3 times you're going to lose. Here, this is almost a coin flip. Here, this is showing a delta of a 1. Which is basically the market makers are saying that that steel is going to close below 1450, which does, of course, show kind of a flaw in this rule of thumb that delta and probability always plays out. Because do you really expect me to believe that there is 0 chance that steel could drop back down below 1450? I don't think so. Anything's possible in this crazy world of stock options, right? But delta is another way of explaining the risk, right? But when you are buying calls and the expiration date is very near, then the stock absolutely has to make a move. And that's the difference between the other way that I do it, where I'm buying these leaps. Like if I were to go to the option chain here and I were to buy, let's say, let's close this out, and I were to buy these ones, okay? These are a lot cheaper, but the delta is also a lot lower, and you won't get as much of a move, you won't, or as much as of a push when you're buying the leaps. So it really depends on your risk tolerance. So when you're buying and selling calls and puts, and they expire by the end of the week, those are more risky because the stock must move, and it must move higher than the money that you paid for the option. I paid $36 for these $15 calls. And when I bought the 15, steel was at $14.40. Now steel went all the way up 5%. Actually, that's showing a red, my bad. But it's up to $15.08, $15.16, so like $15.10. And even though it went up all that much, steel, it still looks like that there's a reasonable chance that I might lose a little bit of money here. So my game plan for tomorrow is I'm going to wake up when the market opens. I'm going to wait till about 7:30, and if I'm in the money at all, and I don't just mean in the money, but if I'm past my break-even price and I can make even just $10 or $20, I'm going to get out and I'm going to take that profit. If I'm not in the money, then I'm going to wait until the market closes. I'm going to wait till like 3:30. Actually, I'm on the West Coast, so I'm going to wait till 12:30, and then I am going to take whatever is left in the options. And if I take a loss, I take a loss. I'm certainly not going to wuss out and say, well, you know, I lost $15 and then I sell the calls and then steel decides to go up to $16 or $17. I'll be kicking myself. I would rather risk the $80, take the chance of making $100 or even a couple $100 rather than get out and barely lose money because I'm so scared of losing money. Okay, I chose of my own free will and choice to take this risk, to buy these two calls, and I'm going to roll with it. So that's the end of this video. As always, if you have any questions or comments, feel free to leave a comment, and always appreciate any support or views or feedback or whatever. Thank you very much, and happy trading to you all. Be careful out there. Stock options can be scary, and I don't know how much sleep I'm going to get tonight, but you know, this is the life I choose, and I enjoy it. Thank you, and see you in the next video.